Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And on the back of last week's softer than or cooler than expected inflation print and some follow through this week with regards to Chairman Powell's testimony to Congress with regards to, with his interview yesterday with regards to um, his statement that he believes inflation is trending in the right direction towards a 2% goal has had a pretty significant impact on what the bond market is pricing in terms of rate cuts for this year. As of the end of last week, we were looking at two rate cuts. As of this morning, the bond markets are now pricing in three rate cuts, one in September, one in November, and one in December. That has obviously fueled the equity markets at the moment. So what we want to take a look at today is where the charts stand with regards to the equity market. So over the past month and a half, equity markets such as the S&P 500 continues to make a new higher high. We talked about the fact that there was some signs of exhaustion here on the moves higher, but so far those new highs have been confirmed by momentum. So that is an overall positive to the broader markets that we're currently seeing from the mega cap indices. And we see it from both the S&P 500 as well as on the NASDAQ 100, both of them making new higher highs, being confirmed by higher highs in terms of momentum. So that's largely constructive here for the mega cap indices. But what was really interesting over the past few trading sessions is how much the small caps have played catch up here. The relative performance in small caps have caught up nearly 7% in relative performance in just the last three trading sessions since Thursday. Now, we've been talking about the fact that because small caps have not joined in on this rally, the health of the market rally was quite poor. But we have seen that reverse very significantly in the last the last three sessions. And the question is whether this can continue. So far, as of yesterday's price action, it has continued, which is a pretty incredible reversal to the lack of participation that we've been concerned about for the past 5, 6, 7 months now, going into the seventh month of equity markets moving higher. But as you can see, small caps moving sideways during that time. That has reversed in just three trading sessions. And we'll see whether that continues going forward. But as you can see, we've seen a fair amount of strong gap higher in terms of small caps on high volume. So this is all incredibly positive for equity markets at the moment. Not only do you see it from small caps, you also see it from the equal weight S&P 500 index. Not as dramatic on the equal weight, but as you can see, we are just flirting with that all-time high on the equal weight S&P 500 index. We would really like to see that continue moving higher in order to have a clear confidence in the equity bull market that we're seeing at the moment. If you look at growth versus value, we have started to see value outperform growth over the past few trading sessions. The long-term trend is still up and to the right in terms of growth outperforming value, but we have seen value outperform over the last few trading sessions. We've also started to see commodities moderate here. We've seen gold and oil moderate a little bit in this type of environment. So commodities very much trading kind of in a range-bound motion here right now. My expectation is potentially for a little bit more further downside here from commodities, a little further weakness from commodities, given the strength that we see here in equities and the flow into equities and out of other asset classes. We also have continued to see a risk-on signal here from high-yield corporate bonds. So corporate bonds reaching a new relative high, giving us that risk-on signal here. Not only are we seeing it from corporate bonds, we're also seeing it from treasury bonds, and we'll take a look at that chart here in a couple of minutes. The VIX did see a little bit of an uptick here yesterday, slightly over 13%, still on the lower end of the range with regards to volatility. And as volatility continues to compress, this is certainly a risk, I think, for a lot of traders that are taking short vol strategies, even though short vol is really what's working over the past 2 months. Little spikes in volatility are always going to hurt. And the risk here is that you see a huge spike in volatility as it kind of continues to compress. So VIX showing us at the moment a little uptick in terms of expectations for volatility over the next 30 days. But I think that's not necessarily investors being fearful of the markets, but just perhaps a little optimism around what's to come here over the next 30 days with regards to earnings season um, and changes with regards to the rate cut expectations. We do see 10-year yields moderating around 4.2% and hasn't broken below 4.2% here. This is kind of an important level to pay attention to, is to see if we can crack below 4.2. That would suggest that the bond markets have continued to price in further rate cuts for this year. At the moment, 10-year yields hovering around that 4.2 level. If we break below 4.2, we're certainly heading potentially below 4.0. That would be the next obvious target. And we're currently looking at, treasury bonds here, as you can see, falling off a little bit here yesterday. We're really seeing if TLT can break out above 94 as a risk on signal here for the overall market. So that's the key level we're paying attention to here on TLT, is 94 breaking out to the upside. We do have 105 on the dollar index breaking below that level here. We've cracked below that level. We're now kind of rallying a little bit to retest these levels as resistance. My view is that you're going to see some further weakness here from the US dollar relative to other currencies. We have seen the UK 10-year yields break below 4.0 as the Bank of England continues to, look at rate cuts. But overall, globally, against the euro, against the Australian dollar, Canadian dollar, US yields are starting to tumble, and that would certainly put more pressure here on the US dollar to further downside. Looking at gold here, gold continues to rally into that 2450 level here. As you can see, this is now the third time we've tested 2450. Can this break out higher and continue moving on? If it does, that would be a pretty significant bullish signal. You basically have a triple top at 2450. So far, it certainly looks constructive for that potential breakout above 2450, and that would be a much stronger bullish signal here for gold. We have seen central banks around the world continue to buy gold, and that's been the demand. That's been the driver of demand, and I don't necessarily see that demand waning at the moment. So that is kind of a fundamental thesis for why you can see gold break out above that 2450 and continue moving higher. That's going to be a positive for miners, gold miners, Freeport, McMoran, those types of companies that are, big miners of gold and copper. Those are potential beneficiaries of commodity prices like gold and copper rising. We did see oil moderate a little bit, continue to moderate below that $84 level here. My hunch is that you're likely going to revisit $80 here to the downside, because geopolitical tensions in the Middle East and inventory levels have not been enough from a fundamental perspective to push oil above 84. So we're starting to moderate a little bit. I wouldn't be surprised to see this trade back to 80 and potentially even a little lower below 80 going forward on oil. And then if you look at the sectors here, this is really what's interesting, is the fact that over the past 3 trading sessions, we have seen a significant outflow from the sectors that have been outperforming. So specifically technology, one of the few sectors that have outperformed the overall markets, and outperformed the overall markets, underperforming here over the last 3 trading sessions. As you can see, nowhere near all-time highs in terms of technology, while other sectors like consumer discretionary continuing to show a little bit of strength, but also the big gainers are some of the other sectors like financials. You've seen financials break out to a new relative high. Relative performance quite strong here. Consumer staples underperforming here, But if you look at healthcare, starting to show a little bit of strength here, as you can see, healthcare breaking out above this 147 level here to the upside. That is a fairly significant level for healthcare to start flirting and potentially breaking out from. You have materials that has shown quite a bit of strength here over the past few trading sessions. Industrials, just pushing this 126 double top level here. A breakout above 126 would be fairly constructive here for industrials. Real estate breaking out above this $40 resistance level, this double top level that is now providing support. And then you have energy also breaking out higher here. You have utilities breaking out higher, reversing, giving up some of those gains here yesterday. So we'll keep an eye out here for utilities, see if utilities start to show some strength here on the back of lower rates. And then home builders, another big beneficiary of the lower interest rate environment. This 110 level is a major resistance level that I think we have to pay attention to, as well as this 112.50 level. So home builders, up nearly 8% here, 8-9% from the pre-inflation print lows. Certainly one of the main beneficiaries, but up against some major resistance. So in the short run, you could potentially see some moderation here. But if we do break out above these two major resistance levels, that would be a strong, strong positive for home builders as a sector. And then what's interesting is that semiconductors have really gone nowhere over the past few weeks, losing a little bit of relative performance. So what we're seeing here overall is the fact that the strongest sectors are the ones that haven't been particularly performing, and there's been outflow of the strongest sectors into some of the weakest sectors like real estate, utilities, materials, industrials, financials, which is overall healthy. You need to see sector rotation from leading sectors into lagging sectors in order to have confidence in the overall market or the health of the market rally. So the fact that you have small caps in the equal weight index playing catch up, you have sector rotation that we've been looking for months and months and months starting to play out here. The more we see of that, the more confidence we can have in the overall equity rally. So with that, let's take a look at some of the ideas here for today. The first one I want to pull up here is Alphabet. Alphabet on a pretty strong upward trajectory, pulled back here to that 185 level here, basically looking for that small pullback to be an opportunity for further upside. Alphabet trades at about 25 times forward earnings, which is a slight premium to the average S&P 500 stock. But if you consider the fact that both EPS and revenue growth rates are quite stellar, you're looking at about 18% EPS growth rate. That's nearly triple what the average S&P 500 stock is expecting. Revenue growth a little over 11% with industry-leading margins of about 26%. I think that the fact that Alphabet trades about 25 times forward earnings is relatively inexpensive given the relatively strong margins and the strong growth rates that's expected out of Alphabet. Another one I want to take a look at is Taiwan Semiconductors. This was an idea that we posted last week on our Tuesday morning session. Last week, we were looking for the breakout above 184, and so far we've gotten that breakout above 184, and now what we're looking for is that continuation higher here. And what's most interesting about Taiwan Semiconductors is that it only trades about 21 times forward earnings, yet EPS growth is expected to come in around 23%, revenue growth is expected to come in around 22%. So you're talking about very, very strong growth rates, not to mention net margins of 38%. You really don't see a lot of companies with net margins that are exceeding 30%, certainly not ones approaching 40%. So the fact that it's got super strong margins, extremely high growth rates, and it's trading at only 21 times forward earnings, which is the exact average of the S&P 500 stock, leads me that this is significantly undervalued. And when you have the technical picture here of that pullback to that 185, I think is a good entry for long exposure into Taiwan Semiconductors, especially if those of you looking to invest kind of into AI as a theme. Taiwan Semiconductors is certainly at the forefront of NVIDIA's foundry operations for their chips. The next trade I want to take a look at here is Lululemon. Lululemon, as you can see over the past a few months, have severely underperformed the overall market. So this was a $500 stock that's now below 300. But as you can see, lower lows in price continue to be coupled with what we consider positive momentum, right? So lower lows in price no longer being confirmed by lower lows in terms of momentum. That means that sellers are starting to get a little bit exhausted here, and there's a potential buying opportunity. If you look at the fundamentals, Lululemon now trading at a very reasonable 20 times forward earnings. So a slight discount to the average S&P 500 stock. Growth rates, they're not that spectacular, but they are better than the average S&P 500 stock. 11% EPS growth, 10% revenue growth, net margins of 16%, which is pretty good for retail stocks. So the fact that you're growing slightly faster than the average S&P 500 stock, good margins, yet it trades at a slight discount to the average S&P 500 stock, leads me to believe that this is a stock that's at least modestly undervalued. And then when you look at the technical picture where sellers are clearly starting to get exhausted, that presents kind of that buying opportunity for a stock like Lululemon. Charter Communications. Charter Communications was on our list last week here as well. We were talking about the fact that this stock could potentially break out from that $300 level here, and that's exactly what we got here this week. We got that breakout here above 300. Our upside target here is around 370. We're in the very early stages of what looks like a reversal here. This has completed a 1, 2, 3, 4, 5.5 month bottoming formation that's now been completed and resolving itself to the upside. And there's really not much volume that's traded between 300 and 370. And this is really kind of where the upside expectation up to 370 could materialize relatively quickly. And Charter Communications, while not expected to grow very fast, only trades at 9.5 times forward earnings. So when a stock trades at 50% discount to the average S&P 500 stock, it's an attractive valuation, or it's certainly the downside is fairly limited in this particular case. So Charter Communications, another bullish idea that we have here for the week. And then two bearish ideas. First one is Spotify. As you can see, Spotify, this is a stock that was a $130 stock that became a $300 stock in a very short amount of time. But after rallying from 130 to 300, which is effectively a 130% rally, the stock has really been trading sideways since then. And as you can see, the relative performance since it hit 300 has not been there, meaning it had outperformed the markets for a long time, and then it stopped outperforming the markets. And just in the last week or so, we started to see some underperformance here. So as you can see, if you draw a line here, let me draw it a little bit tighter for you so you can see. As you can see, it's starting to drop below this support level. And what that's telling us is that, this is a stock that's been trading sideways is starting to fall a bit out of favor relative to the S&P 500. Momentum has also recently turned negative here. And the big thing is really just the fundamentals. This stock trades at 65 times forward earnings. That's fiscal year 2024 earnings. If you look at fiscal year 2025 earnings, it's still trading at 40 times forward earnings. That's double what the S&P 500 stocks are trading at. It is expected to grow quickly, 35% EPS growth, 15% revenue growth, but keep in mind that 35% EPS growth looks really strong because they currently make no money. So their earnings are basically zero. So whenever you start from a zero base, growth always looks high from a percentage perspective. So for those reasons, remember, Spotify is not profitable today. They spend every single dime they make in terms of revenue on marketing and trying to grow market share and content. The path to profitability is potentially not as strong as perhaps analysts would like it to be. And given the fact that it trades at 40 times forward earnings, I think is an overall risk to the valuations here. So if you start to see cracks form in the chart like we are doing right now with that relative performance starting to show some cracks, and you have a valuation that's extremely hard to justify, those are the opportunities that you can see some potential quick moves here to the downside. And Spotify certainly ticks those boxes as a potential bearish candidate. Doesn't mean that it's going to drop, but for the stocks that drop, those are the ones that tend to drop the fastest. And the last one I'll leave you with is Costco. This was also one of our trade ideas from last week. We were basically referencing the fact that as we were making higher highs in price, this was no longer being confirmed by higher highs in terms of momentum. And what we have seen is that Costco is now trading just above that 840 support level. But as you can see, the relative performance of Costco is starting to show some cracks here as well. And this is also another one where the technicals are basically showing us there are some cracks forming, but the fundamentals tell the real story. This is a stock that's trading at 48 times forward earnings. That's more than 150% more than the average S&P 500 stock. It's not expected to grow at some, really spectacular growth rate. We're talking about 11% EPS growth rate. Revenue growth is about 6.5%. But the real kind of nail on the coffin is the fact that Costco is barely profitable. Just like most supermarket stocks, for every $1 they earn in revenue, they only earn 2.83 cents in net profits on their dollar that they earn in terms of revenue. So we're talking about very thin margins, net margins of 2.8%. So this is a stock that for every dollar they earn in revenue, they make very little in terms of profits. So when you have stocks that don't make a lot of profits trading at these really high valuations, that's really very concerning to me, especially when growth rates are not particularly stellar. So Costco, big run up, right? This is a $500 stock at the end of last year that's now become a $900 stock in a very short amount of time. And I think that there's some signs that buyers are starting to get exhausted, that there's not enough buyers to continue to push this market higher or push the stock higher. And there is that real risk that it's been trading up against this 840 support level for about a month now, that this 840 support level could potentially break and things would tumble fairly quickly from there. If we do tumble, I think that we're going to easily shoot to that 740 level here. So about $100 lower to the downside for Costco based on the valuations and based on the technical picture. So that covers what I wanted to share with you here today. Hopefully that gives you a pretty good, clear sense for kind of the overall markets, which have certainly shifted a lot more to a much more bullish tone and much more confidence in the overall market rally, and some of the ideas that we see in the markets for this week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.